Well, Pictet Asset Management released its 2026 investment landscape, saying the outlook for global equities will start improving. Our next guest says he expects the macro backdrop to switch from mild stagflation to a Goldilocks environment over the next year. Let's get more from Arun Sai, senior multi-asset strategist at Pictet Asset Management. Arun, thank you very much for joining us.
Thanks for having me.
All right. What makes you think Goldilocks is coming next year?
Right. So I think we have to keep in mind we are going to go through a phase where macro data is going to be quite hard to pass, but we are looking ahead of that. And we have to keep in mind that policy is going to be supportive for much of next year, both on the fiscal and on the monetary side. We continue to expect the impact of rates relief to feed through into the real economy. So all of this will, in our view, contribute to, if anything, an upside surprise on growth. And that leads us to be quite constructive, overweight equities. But we have to keep in mind we're not going to shoot the lights out. This is not going to be a year when returns are going to be high. We have mid to high single-digit returns for global equities in mind. And within that, we have to be very selective because equity investors in particular have a double whammy facing them: very high valuations and extremely high levels of concentration in markets today.
And where are you looking when it comes to that? Which area, do you have areas that you're liking, areas of concern?
Right. No, absolutely. When we have low returns and high volatility as the environment, we have to be very selective where we take risks. And we like, for instance, value and value-oriented strategies in Europe, in Japan, where we see a modest cyclical recovery play out, and also fiscal support for most of the year. On the other hand, though, in US, we like growth. We still want to be selectively exposed to the AI CapEx cycle for now. But through the year, we expect that to broaden out into other areas.
Okay, let's talk a little bit more about Europe. What are you favoring there?
Right. So the structural and cyclical issues, headwinds facing Europe is very well flagged, and we think that's well priced into valuations today. So we need to keep in mind, though, that expectations on the Germans, for instance, following through with fiscal spending, especially on infrastructure and defense, is very low. So that sets up a very low hurdle for an upside surprise. So if we do see traction on that front, we think there would be outsized returns in European equities, especially in European and German mid-cap. That said, we are framing this as a cheap optionality within a diverse portfolio. It's not our base case call. Our base case is that European equities would still struggle to match US and EM returns, but it offers us a cheap optionality for upside.
And the other one in Europe you're looking at is healthcare.
No, absolutely. Healthcare for us is a great opportunity because this is a sector which has had a series of headwinds the last 2 or 3 years. It's underperformed for 3 straight years. The valuation case is very clear. But as always, we have to look for catalysts to unlock that value, and we think those are falling into place. We think we are now past peak policy uncertainty, both on the tariff and on drug pricing. And we have a very constructive outlook for M&A in the sector. So healthcare for us isn't just a preferred defensive play, but we think it gives us a very interesting opportunity to get in on an innovation cycle in quite an early innings of that playing out.
And in Japan, where are you looking in Japan?
We like value. We think we are in for a cyclical recovery. We see a bit of curve steepening as well. That should help the banks. We still see some of the value up kind of programs, corporate governance improving, and all of that play out. That has legs as well. So all of that tells us that value over growth should be a good trade in Japan for at least a year ahead.
Okay, and you're also looking at emerging markets. What's so appealing to you about them?
Yeah, no, see, the promise of EM isn't new. Right? So when it comes to EM, we should always ask ourselves, why EM now? And on that, we think the macro backdrop is quite enticing. If you think of a lower dollar, if you think of rates continuing to come down, a modest global manufacturing recovery, higher commodity prices, typically when you have these drivers in play, we find that EM outperforms about 80% of the time. So that's a very strong macro tailwind. But it's not just that. At a domestic idiosyncratic level, we are seeing strong drivers, and we are seeing opportunities across the investment spectrum. So we don't want to be boxed into certain investment styles. On one end, we like India, where we think there's a very clear growth positive policy pivot that should, if anything, give us a growth surprise next year. Valuations are not unreasonable. And other end of the spectrum, we like Latin America. We think there's significant scope for real rates to come down, and you would see a bit of a multiple expansion and a cyclical recovery on the back of that. So there are opportunities across the board, and not just in equities, in EM, local currency, hard currency bonds as well. So we think it's quite an interesting time to pick up opportunities in EM.
All right, Arun, we're going to have to wrap it up there, but thank you very much for joining us.
Thank you.
Arun Sai is Senior Multi-Asset Strategist at Pictet Asset Management.